Good morning. Welcome to Market Monday. We hope everyone made it through Valentine's Day okay, despite the inflation there. This middle line here is the most recent headline CPI of 6.4%. It looks like travel-related items are still up significantly compared to January of last year. Remember, headline CPI is compared to a year ago. Looks like drinks out and entertainment are in line with overall inflation, and perfumes, flowers, and jewelry are below overall inflation. So hopefully you found some good deals in those areas. Well, as we said last week, Fed watchers would tease apart the 6.4% CPI inflation number. Let's have a look. Here, we're breaking down 2 years of CPI into its components. When you add them all together, you get headline CPI, this black line at the top. Without saying what each is, what do you notice? One thing is the blue bars getting smaller. That's core goods, things, items. Remember the supply chain woes of last year? Looks to have peaked in February and March of last year. The magenta bars appear to be holding steady, perhaps a bit smaller than fall and winter last year. That's core services excluding shelter. Think airfare, hotels that we just looked at for Valentine's inflation, medical services and such. What else? Looks like the red bars, wow, look at that, smaller than they've been in a while. That's food and energy, kind of important. These yellow guys here seem to be getting larger. That's shelter. We got to see what's going on there. The shelter component of CPI is very important. It makes up 34% of headline CPI and over 43% of core CPI, and has been between 41 to 43% of core for about 20 years now. Going back to headline CPI, this is right from the BLS, the organization that calculates CPI. We have the 34% overall shelter weighting, and the main two components are rents, what folks are paying for apartment rents, rental homes, etc., and this thing called owner's equivalent rent. Wow, 25% of overall inflation. Must be important, but what the heck is it? Well, first of all, it's a survey. Great, because people always do what they say they're going to do, right? Well, what does the survey ask? If someone were to rent your home today, how much do you think it would rent for monthly, unfurnished and without utilities? Wait, so you're asking me what my home would rent for? And we don't have to actually test my number in the market to see if it would actually rent for that price? I don't know about you. I've never known anyone, myself included, to accurately value their own real estate. But it's mine, it's special. So this is owner's equivalent rent, and it comprises 25% of headline CPI and almost half of core CPI, and this has a huge impact on the Fed raising rates and the entire business cycle. Well, here's what that very precise and scientific owner's equivalent rent looks like. A pretty steady 3.5% yearly increase for the last 35 years. Makes sense. Then boom, and despite many other inflationary areas cooling off, this one's still heading higher. Are you surprised? Certainly causing those yellow bars to keep growing larger. But let's get real, right? There's gotta be a better way to make sense of this shelter thing. Indeed. What we have here is these green and yellow lines are the actual CPI components we just talked about. Rent in green and owner's equivalent rent in yellow. Both still trending up, those yellow bars from before. Still contributing to sticky high inflation. We also have 3 much more timely and responsive metrics that all seem to confirm the same thing. A sharp increase higher, sharper than the CPI components, a peak in late 2022, and swiftly coming back down to planet Earth. Again, that theme of market-seeking balance we've been talking about since the beginning of the year. What else? Well, despite a higher inflation number than most would like, it is heading in the right direction, which has caused folks to shift their worries to earnings. Humans are great worriers, aren't we? But earnings are important, especially over long periods of time. That's the most basic reason for owning stocks, to participate in their earnings, either in the form of growth and price appreciation, or to receive those earnings as a dividend. And looking back, major market drawdowns coincided with earnings declines. Early 2000s dot-com crash, global financial crisis, 40% decline in earnings, my goodness. And of course, COVID. Right now, we're at about a 5.5% drawdown in earnings. Question is, does it keep going further like in prior recessions, or does it pause and turn back up like in the 2015 to 2016 timeframe? Or could it be that our economy, now almost twice as big as it was before the global financial crisis, is diversified enough to handle these rolling recessions, where certain sectors may experience slowdowns, but other sectors are resilient enough to absorb that one sector slowdown? I do think it's important to consider that. And today we'll wrap with potentially some good news. Here's the amount of firms, from large companies to small public companies, mentioning the word recession during quarterly earnings calls. At 12%, still elevated compared to the past 13 years, but down significantly from its recent peak of over 40%, and less than half during COVID. And then we have a Bank of America Global Fund Manager survey showing the percent of fund managers saying a recession is likely in the next 12 months. The reason I say potentially good news is because look at the other peaks. March 2009, the bottom of the financial crisis, and April 2020, very close to the bottom of COVID. And here we were, this survey peaking in November last year and heading lower, with the market so far bottoming in mid-October. Lots to think about. Have a great week.